that are going to be there and derivative market features. This is the first learning module within your level 1 derivatives, and we're going to talk about the features of both derivative instruments and derivative markets. We'll do this in 3 videos. So in the first video, we'll talk about the features of the derivatives. In the second video, we will talk about the different underlying assets that can be there. And in the third video, we'll talk about the markets. Now, whenever there is a business transaction, there are at least 3 things that are going to be there, which is, let's say you're buying any good or service. What is the price, when you will make the payment, and when you will get the delivery of that good or service. Let's say you're going to a shop and buying a bottle of water. Now, if you're making the payment right now, you're getting the delivery, you're getting that bottle of water right now, and the price is being established right now as well, then this is what we would call a cash or a spot market. Why the word spot? Because this transaction is settled on the spot. And even though we're talking about a bottle of water, but this could also be easily for stocks or bonds. So what we're basically saying is, if you're paying for that stock right now and the transaction is settled on the spot, then this is what is known as a cash market or a spot market. It could be for currencies as well. So let's say you're going to the money exchange, giving them dollars and buying euros, right, on the spot. Again, an example of a spot market. You're going to, let's say, a dealer of gold. You're going to buy some jewelry or just, just gold. So this is spot market. Now, if let's say, even though the price is being set right now, that we are going to buy 1 troy ounce of gold for, let's say, $1,500, but the payment will be in the future, that we will make the payment after, let's say, 6 months, and the delivery will also be in the future. So we're just getting into a deal, like a contract between us and the jeweler, that they are going to give us gold after 1 month and we're going to make the payment after 1 month, but the price is being locked right now. So the exchange of cash flow will be in the future, and this is the world of derivatives. Now, what this reading will cover, or this learning module will cover, is what is a derivative, what are the different types of derivatives, and then the market in which these derivatives are traded, what are the features of those markets. Now, first, let's talk about the features of the derivative contract itself. And I want to really emphasize on this word derives, because let's say, again, we are talking about the gold transaction, that we're going to buy this ounce of gold in the future. The payment will be in the future, the delivery will be in the future, the price is being locked today. So the asset, the underlying asset, is a ounce of gold, and our contract, this legal contract that we are getting into, is based on this underlying contract. Hence, it derives its value from the underlying asset, which is the ounce of gold. Hence, this legal contract is what we call a derivative. So a derivative is a financial instrument which is actually a legal contract, which is based on an underlying asset, and it derives its value from this underlying asset, and this is what is a derivative contract. Now, naturally, there is a buyer and a seller. So there are 2 parties, and what we call them are counterparties. There is a buyer and a seller. One important thing for you to understand, that the buyer is called the long party and the seller is called the short party. An easy way to remember this is S for short and S for seller. Let's look at an example. Amy Investments is getting into a forward contract So this is like a future contract, and I will tell you the differences between a forward and a future contract in a later video. But they're very similar in the sense that they're about the future. So at a future date, and here that date is after 6 months. So currently we are at time 0, and at time is equal to big T, which is after 6 months in this example. What is Amy Investments agreeing to do? They are agreeing to deliver 1000 shares of Airbus at a price of $30, 30 euros per share. So after 6 months, they are agreeing to give 1000 shares of Airbus at 30 euros. And let's say the spot price in the market is 25 euros. So because they got into this contract at time 0 that we will sell for 30, and after 6 months they are receiving the payment based on 30, that 30 into 1000 shares, they are receiving 30,000 even though the price in the market has fallen to 25. So Amy Investments will be very happy. Why they will be very happy is because they will still receive 30,000 even though the shares are now worth 25,000 only, because the market of the share price has gone down to 25, and 25 into 1000 is 25,000. So they will be very happy because they locked in a higher selling price. And this is the advantages of using a derivative if it goes in your favor. Now, it could very well go against you as well if the price, instead of 25, let's say it was at 35. Then in this situation, what would have happened? They wouldn't have been very happy, right? Because they would be selling something for 30 when they could very well sell it for 35 in the market. So this brings me to the other type of derivative contract. Now, the one that we just discussed is what is called a firm commitment, and we looked at a forward contract, right? A future contract is also similar, and swaps are also an example of firm commitment. But the important thing is that this is a firm commitment, which means both parties have, both long and short parties have an obligation, which means when Amy agreed to sell this for 30, this Airbus share for 30 euros, that means they have to sell it for 30 euros. Whether the price goes up to 35 or it goes down to 25, it doesn't matter. Amy has to sell this for 30 euros after 6 months. So even if it goes down, they will be happy, right? Because obviously they're selling something for 30 which is now available for 25, but they will be sad if it goes up to 35, because they can sell something in the market for 35, but they will be forced to sell it for 30 because this type of a derivative contract is an obligation. Now, there is another type of derivative contract category which is called contingent claims, and one of the examples of that is options. Now let me give you a practical example. So there is a type of option called a put option, which means Amy has the right but not the obligation. So this is very important. They have the right to sell. So when they buy a put option, they have the right to sell this share for 30, but there is no obligation. So in the case that the share price goes to 25, they will be happy because they have the right to sell at a higher price. And in the case the share price goes to 35, then they will still be happy because they have a right but no obligation. So what will happen in this scenario is that if the price goes to 35, they don't have to sell at 30. It's a right, not an obligation. So they will not sell at 30, they will sell at 35. So they'll be even happier, right? And in case it goes to 25, then at least they have the right to sell at 30, so they will still be happy. At least they're getting more than the market. So this is the other type of derivative category, which is called contingent claims. And of course, naturally, we're going to talk about all of this in a lot more detail. So here we're just giving you a introduction. Okay, so what is the benefit of all of this? Derivative markets expand the set of opportunities available to market participants beyond cash market to create or modify exposure to the underlying. For example, look at this. They can sell short to profit from the decline in the underlying's value. And this is very similar to what Amy has done. So they sold something for 30 in the future, and the price actually went down to 25, and they were very happy because they were able to sell something for a higher price than what it is worth right now, and they can rebuy it at a lower price, right? So they can profit from the decline of an asset's value. Usually in cash markets, you cannot do that, because in cash markets, you're going to buy something and you will only make money if the price of that something goes up, right? You're not going to make money if the price of that something comes down. But in a derivative market, you can actually profit from the decline as well if you sell it in the future and you rebuy it at a lower price later on. You can also use it to diversify for your portfolio. So let's say they have Airbus shares. So Amy Investments has Airbus shares, and what they do is they sell those in the future. So now they know for sure that they have sold at a good price, and what they can do is they can use that money, or at least they can know that this money will be coming to them for sure, so they can borrow some money from somewhere else because they know they will receive this 30,000 in the future. So they can borrow 30,000 and maybe buy Boeing shares, right? So they just are not having only Airbus shares. They can sell some of these Airbus shares in the future, lock the selling price, and they can buy Boeing shares as well. So they can diversify their portfolios, or they can maybe buy some completely unrelated investment if they want to diversify away from airline industry, something safe like not related to air travel, because maybe they want to invest in food or let's say oil price, because if oil price will go up, airline shares will come down because they use oil as a raw material. So they can diversify their portfolio like this. And talking about oil price and airlines, so let's say there is an airline. Let's talk about American Airlines. And American Airlines is issuing tickets for the future. Customers are booking tickets for next year in advance, right? And American Airlines is worried. Why they're worried? Because what if the oil price goes up? Then their cost will go up, but they're already issuing the tickets. So what they can do is they can buy oil in future. Buy oil in future at current price or related to the current price. So they can issue these tickets for next year based on the oil price that they are getting in the future contract, and they can manage the financial market exposure, because oil goes up and down in the financial market, right, because of financial market factors. But this is a commercial transaction that they are issuing tickets for next year, so they can manage the risk of their commercial transaction, and they can take out the risk of the financial market exposure by using a derivative contracts, that is buying oil in the future, right? Another advantage of derivatives is leverage, and we will talk about that in more detail. That what you can do is you can create very large exposures to an underlying with a relatively small amount of cash, because what you don't have to do is pay the whole money up front. So what happens in derivative contracts, that because you have to pay later, you can get into very, very big contracts. You can create large exposures and not pay anything right now, because obviously you're saying that I will pay later. And that enables you to have a very small cash outlay or almost zero cash outlay right now and get into a very large position. Derivatives are typically more liquid, which means easier to get into big positions compared to spot markets, because in spot markets or cash markets, you have to have somebody willing to supply you or deliver you that asset right now, right? But derivatives, it's all about the future. So they tend to be a lot more liquid. That means it's easy to get into much bigger transactions and at a much lower transaction cost. So it's very, very good for people to do big transactions easily. Now, what is hedging? So hedging is basically managing your risk. And this example I gave you is one that is a hedging example, that American Airlines issuing tickets for next year, and they are having a risk of oil price going up. And what they do is they hedge their risk by buying oil in the future. So they hedge their risk, right? So they're offsetting or neutralizing an existing or anticipated exposure to the underlying. Now, all of this is done based on term sheets and practically speaking. So you have to be able to read this kind of a document. And we're going to talk about the same example where Amy Investments is agreeing to sell or deliver 1,000 shares of Airbus at 30 euros per share 6 months from now, right? So 6 months from now, they will receive 30,000, which is 30 euros into the 1,000 shares, and they will have to deliver these 1,000 shares regardless of whatever is the price at that time after 6 months. Now, when we look at the term sheet, what does it tell us? Number one is the contract type. So is it a firm commitment or a contingent claim, right? So this is definitely a firm commitment, and it is a forward transaction. So that means it is an obligation for both parties. What is the maturity date, right? So this is 6 months from the start date, and start date is today, spot start, right? As soon as you get into the transaction on the spot. Who are the counterparties, the legal entities entering the derivative contract? Naturally, there is a forward purchaser or the long party, and there is a forward seller or the short party, and that is Amy Investments. The underlying asset here is 1,000 shares of Airbus, and this is traded on the Frankfurt Stock Exchange. The contract size is 30,000 euros, right? Because it is 30 euros into 1,000 shares, and that is the forward price, which is the underlying price is 30 euros per share. And the contract details, business days Frankfurt, and this is the association of derivatives, which is the documentation agreement is going to be based on the ISDA, which is the Association for Derivatives.